percentage growth doesn't equal dollars growth. Now, here's what I mean by that. Year one, like I was on a call with the brand founder the other day. I'm like, hey, what's your goals for next year? They're like, well, we've been growing 100% year over year for the first 3 years of the business. So our goal is to just grow 100% again. I'm like, hold on a second. First year of 100% growth, what was that in dollars? 100K. Okay. Second year, what was it? 250K. Okay. Third year, what was it? It was 750K. Okay. What is 100% year over year growth this year? It's $2 million. Okay. Well, growing by $2 million is not the same as growing by 100K or 500K. What would it really take to generate this many dollars? Hey, what's happening, everyone? Ecom Scaling Show, episode 6. Dylan, we made it, man. 6 episodes. What's up with that, bro?
Yeah, it's been a good time. It's been a good time. Hopefully just the start of very many more to come. But I'm excited to talk today about marketing metrics and the relationship with debt. I think it's like something that a lot of people don't spend a lot of time thinking about when they get into ecom, but certainly a huge lever to pull when kind of trying to optimize for scale and obviously going bigger. I'm looking forward to hearing your takes on it, and yeah, it's gonna be good.
Yeah, man. I wonder if there's any other podcasts out there who have talked about the marriage of marketing and debt. It's not, those two things really are rarely talked about, but actually, I'm really excited because really when it comes down to debt, right, in my mind, I'll kind of like lay the framework or at least lay the groundwork with like kind of an initial foundation of how to think about debt. The reality is debt is a form of capital, right? And generally speaking, there's 3 forms of capital. There's outside equity or new fresh equity, there's debt, and then there's inside equity or your retained earnings and the retained profitability of the business, right? Why does debt matter in the context of D2C? One, probably most importantly, because most D2C brands have little to no accounts receivable, which is the other asset that's typically used to finance debt. And so one, there's a unique risk for D2C heavy or purist brands where you have a riskier, less liquid asset, right, that you are typically financing, that being inventory. And furthermore, when you think about the strategic use of debt, you need to do so with balancing risk, because the difference from a capital standpoint between equity and debt is debt has to be paid back. Equity doesn't necessarily need to be paid back. So although you can lose equity, you can lose it, you don't owe it back to someone. But if you lose the money you borrowed, you owe it to someone, and that's risky, right? So Dylan, in your mind, why marketing metrics and debt? Why are we talking about that here? Why is the marketing piece so important in your mind?
Yeah, I think it's just because different businesses have different unique makeups that will make them either a riskier place to borrow into or a more stable place to borrow into. There are some businesses that are super first order dominant, which, and just for context, first time customer dominant brands or first time customer revenue as a percentage of all revenue dominant brands are often considered to be a little bit less stable in the D2C space because you're kind of at the mercy of what your new customer acquisition is going to be day to day. And to some degree, every single business is. But when you're very reliant on that first time customer, you're normally going to have much kind of larger swings in your month to month revenue. And small changes in efficiency can heavily impact how much you're going to be willing to spend on growth. That's not to say they can't be super profitable. You can have a low margin first customer dominant brand that can do really high volume and produce really solid profit dollars. It's just you may have a business that's crushing it, growing really fast like that, that is inherently riskier than a business that's maybe a little bit more return customer dominant, a little bit more reliable revenue. The durability of the revenue is a little bit more stable, where you're going to be more willing to take on and borrow capital to grow the business. And usually that's going to look like brands with high LTV because no matter what you're borrowing into, let's say it's like a SKU or a new item or whatever, you may want to sell through it in, say, I don't know, 3 or 4 months. And that's kind of the target you have set. If you're very much a first-time customer dominant brand and you're relying on that revenue that's going to come to pay down your debt, all of a sudden, let's say something happens to your acquisition channel and volume decreases by 20, 30, 40%, all of a sudden the time period it takes to kind of go and pay that back becomes a lot more questionable. And maybe you even have to move units at a loss to do it. Versus if you're a high LTV brand, a lot of return customer revenue, you can in your scenario planning have this is like plan A, this is what I think is going to happen. But worst case, I have this kind of base of customers that keeps coming back again and again and again, who I think will pay it back in 6 months, and I can still do so profitably. So you kind of have this other like tranche of revenue that is just generally more stable and reliable and less likely to have huge kind of swings up or down that can allow you to kind of potentially place bigger bets on the debt side because you have a higher confidence that you're going to be able to move the units you need at the efficiency that you want to and in a reasonable time frame. I think that's why high LTV brands or high return customer revenue brands are generally more willing to and able to take on more debt. But again, there's a risk to everything, so it's very much unique case to case.
Yeah, one thing I was thinking about as you were talking is like how to think about this on the margin or incrementally. And so when I say that, I mean that like where I've seen a lot of brands that are basically one and done brands, meaning they acquire a new customer and they basically purchase once. If they purchase again, it's not very meaningful in margin dollars. It's effectively zero from an LTV standpoint. But those brands that are heavily reliant on new customers, let's just think about like what are they borrowing their money for? It's always inventory, like almost always, right? And so if you think about it, you're making a marginal decision. You're buying the next tranche of inventory, usually to get the next dollar of growth or the next $100,000 in growth or the next $1 million in growth. So this is really a marginal decision. And so the question, the risk, how risky is the next marginal dollar spent on growth? That's the way that I view it from a CFO standpoint. And what I think Dylan is saying in CFO terms is that when the next marginal dollar of revenue is basically 100% reliant on acquiring a new customer and scaling ad spend, you're subject as a brand from a profitability standpoint, you're subject a lot more to the law of diminishing returns, right, of ad spend efficiency. Why? Because all of your ad spend is going to acquiring new customers, which is the MER or the full funnel blended ROAS is diminishing as you scale spend. You don't have anyone coming back and buying again for basically zero ad spend, right? Subsidizing that diminishing return. So you have no repeat purchase subsidy to subsidize the diminishing returns on scaling ad spend. So on the margin or incrementally, it actually becomes more and more risky to turn a profit on the next customer that you acquire. That's absent anything else changing in your business, AOV wise, margin ratio wise, or gross margin ratio wise. But so like in my mind, what I've actually seen play out is that in terms of like how to do this from a more risk adjusted perspective is to just be careful about how fast you scale when you're a new customer concentrated in terms of your growth opportunities. Now, I do want to point a caveat out, and I'm sure you have some things to say about this, Dylan. When will the diminishing returns really hit you, really kill you? Dude, it depends. I've seen one brand in the beauty space, they got to 35 million before it happened. But when it happened, things fell off of, like it was like they fell off of a cliff, right? I've seen it happen with other brands when they get to 10 million in revenue. It really depends how nascent your product category is, and or how mature it is and how much competition there is. What are the ad channels that you're currently selling down, right? Do you sell in just the D2C channel, or are you also on Amazon? Do you have some retail? So I think channel mix, product category, and how like nascent or mature that product category is in those channels are big factors. Do you agree, Dylan? And do you have anything else to say about that?
Yeah, I think it agrees. I think I agree. I should say. The other one that I think is just often forgotten is where you sell. A lot of brands start selling in the United States only. There is tons of other markets to sell into. So the more markets you have, oftentimes assuming that your product is going to work in those other markets, that can really help with that problem of the incrementality loss as you continue to scale spend. So I think that's another big one for sure. And channel mix matters a lot. But yeah, like generally speaking, if you are starting to see pretty solid decreases in incremental return, you can start to look to other channels. I think looking at like depending on what you're selling, like what is the industry average of what percentage of these goods are generally sold D2C versus in retail. And a lot of the times retail is still going to be a huge kind of percentage of that overall sales. So I think as a D2C operator, it's a big jump to make, but sometimes that's like the most obvious next step. Or if you feel like you're a very strong D2C operator and you want to just continue growing in D2C, looking internationally. I guess one of the things I've observed at Aplo over time is I think there's been a good number of times where brands probably should have started to look to sell internationally sooner. When they finally did, it was a great opportunity and it performed well. Logistically, it can be very difficult, and I understand why you kind of wait till later in the growth journey to do that. But it's kind of a delicate balancing act because you want to make sure you're, reinvesting in the thing that's already working, i.e., the markets you're already selling into, but also kind of thinking about what's next. And what's next can be more products to try and get more incrementality on top of it, because you can start reaching new markets in that same kind of geographic region with new products. Or do you go out and just scale horizontally with the same offer different in different geographic regions?
Well, one thing I was going to say is whether you're expanding internationally, no matter where the expansion is, new products, new channels in the States, internationally within the same channels. This really does come, like when you talk about financing growth with debt, it really comes down to how big of a bet are you placing, right? So
Yeah.
I like to always go back to real estate examples just because that tends to be something that people are a lot more familiar with. Is like, okay, let's look back in the day. There were issues that got caused in the housing market many years back when people were allowed to buy houses with like 3% down, 5% down. So what does that mean? That means like 95% leverage, 97% leverage, right? They're placing a bet that's almost 100% financed with debt. I'm personally a real estate investor, so like the deals that I've been doing in the last like 8 months, the rules have changed. You can't buy a short-term rental, at least through doing what's called a conventional mortgage in the States. You can't get a conventional mortgage on a real estate investment without putting down at least 25%. So that's only 75% leverage. That didn't used to be the case. You used to be able to put down a whole lot less. The rules changed. Why? Because people were placing too big of bets with almost 100% leverage. And so what is the problem? The problem is that if your bet is wrong, right, you have a huge risk of your asset value, whatever the asset is that you use to finance with debt, that asset value actually decreases in value lower than the outstanding debt, meaning there's not enough asset value to recover the loan in the event that you can't pay it back, right? And so it's not any different for your business. Is like, how big of a bet are you placing, right? How risky is it? And the riskier it is, actually the less debt that you should use, generally speaking. And it doesn't mean that you shouldn't use debt, but like something that's really risky, you may want to think about 50% leverage, right? 50% debt, 50% equity. If you feel a lot more certain about it, and going back to talking about marketing metrics, if you have a really strong subscription base and you've got, months and months and months of retention data showing you have like very low churn, really strong retention, that can mean that that's a less riskier bet to place, right? And also, let's just say that you're purchasing the next couple months of inventory, right? That's much different than I've been in a situation with a brand that was highly seasonal and they did 80% of their revenue the previous year in Q4. And so they wanted to double the business's size, so they placed twice as big of an order for the upcoming Q4, and they turned out to be wrong. We still were able to help them weather the storm because we had done some scenario projections at Free to Grow CFO where we had looked at like, what if they only hit half of their sales projection? Will they still survive? We showed that they would. We would definitely have to like work with lenders, do some renegotiation, restructuring of some debt, bring in a couple like secondary lenders, but we had a path mapped out as a contingency plan of how they would get out of that, right? But they placed a huge bet and they used 100% debt to pay for all that inventory. That brand founder, who I'm good friends with now, he's like, I'll never do that ever again, Jon. Like, we made it out. They're actually debt free now. They're cash flow positive. But he experienced firsthand placing a huge bet, 100% leveraged, which is much different. So like, as a general rule, the bigger the bet, the less leverage you should use as a percentage of the total capital that you're using for that. So if you can place smaller bets that are less risky, you might be able to leverage it more. That's kind of the general rule of thumb that I think through. Are there Are there other things that, like, what do you think? I'm curious because this is where my mind got going telling that story. What do you think about the risk or lack thereof involved in the seasonality that brands have in their
Yeah,
market
I,
efficiency?
I think it's a really big one. I think like especially if you've gotten to, I don't know, like mid seven figures really fast or even into the low eight figures really fast. One thing that we find is that different times of the year have different incrementality for different brands. And you just don't really know what it's going to be until you experience it. And there's a bunch of different ways to try and estimate it, but the reality is that no forecast, unless you get really lucky one time, is likely to be accurate, or likely to be perfect, I should say. So the seasonality element of things makes a huge difference. And I think that when you are basically a general rule of thumb is that you should make sure you're not looking at last month and saying, hey, it's going to keep on going because we found this one ad that worked really well last month and it's like, save my ad account. It's like, yes, that's great and that may help this month, but you're still probably going to experience that same seasonal trend, assuming you're selling the same offer. I think that kind of goes back to like if you've been seasonally slower in this quarter, even though you might be super happy with how the last quarter went, that should probably be a factor in deciding how kind of risk on you want to be, how much risk you want to take with financing. So I think that's definitely a variable at play. And then the other one also with seasonality is like you want to make sure that if you're relying on the sales, to your point, use debt to buy inventory. If you're going to then rely on the sales of that inventory to pay back that debt, you want to make sure that there's another kind of factor for if you have seasonal products, how are you deciding how that impacts your willingness to take on debt? Because that is a whole other kind of realm where even if you have high return customer revenue, if they're not buying the summer products because it's the fall now, it's going to be really hard to convince them to buy summer products going into the fall or whatever season it is.
Totally.
So just because you have high LTV in that case, that's great, but not if they're buying the wrong stuff because you got cash kind of stuck in inventory that's not productive for the next 12 months. So I'd say another thing is like if you have seasonal products, that's another kind of knock where you probably have to go into it with a less levered mentality, I guess.
Yeah, it's interesting. The thing that keeps coming to mind, I tell brand founders this a lot. Just because you can take on debt, like it's offered to you, you qualified for it, you're approved for it, doesn't mean you should take on debt.
Yeah,
It's not just I'm gonna run out of capital to hit, like, in the pursuit of hitting these goals. These guys will give me the capital, so I should take the capital. Like, no, you have to be
why?
like 100%. Like, hey, look, I can go get a $10,000 credit card right now. Should I just go do that and just put a bunch of stuff that I can't afford onto a credit card? No, not unless I have a plan to pay it back, right? And there's a good reason in alignment with my strategy. I think the other thing too to think about, and this probably, like, we probably don't have enough time to get into the weeds on this, but like the other thing about debt and how risky it is deciding which form of debt to take and making
Yeah.
sure you align. They call this, in business school, they call it maturity matching, which basically means that, like, you want to take on debt that has a payback schedule or it matures in alignment with the asset generating cash flow, right? And so I'll give you like a perfect example. Again, I'll use real estate because it's like kind of like easier to visualize. If you're going to flip a house that you expect to sell within 2 years, right? It may be okay to take a 2-year note out on it, right? But if there's a risk that it might take 3 or 4 years, that note may mature before you've turned the flipped house into cash, right? And that's risky. Now, another thing is you don't want to buy a long-term rental that you plan to keep for 10 years with a 1-year loan. You want to put it on a 30-year mortgage or something like that. So the payment of debt matches the cash flows generated. Another thing I see in the D2C space, if you manufacture or you do your own fulfillment, and you need to buy equipment, right? You don't want to put a 6-month loan on a piece of equipment that's going to generate revenue for you over 5 years. You want to try to get a 5-year loan on it, right? And again, you're matching the cash flow generated by that asset with the payback of the debt. So that's another thing that matters. Okay, here's my next question for you, Dylan, because I was thinking about this when we were talking about seasonality. When I was at Guardian Bikes, we were newbies, like it was our first ecom brand. And I hear this from brand founders all the time. And the only reason I want to bring this up is because, like, I'm like, don't. This is a trap. I've gotten caught in this trap before. We made this mistake. And here it is. Percentage growth doesn't equal dollars growth. Now here's what I mean by that. Year one, like I was on a call with a brand founder the other day. They're like, I'm like, hey, what's your goals for next year? So like, well, we've been growing 100% year over year for the first 3 years of the business. So our goal is to just grow 100% again. I'm like, hold on a second. First year of 100% growth, what was that in dollars? 100K. Okay. Second year, what was it? Okay. Okay. Third year, what was it? It was 750K. Okay. What is 100% year over year growth this year? It's $2 million. Okay. Well, 2 million growing by $2 million is not the same as growing by K or for K. What do you have to say about that? Like getting caught in thinking about maintaining percentage year over year revenue growth as opposed to thinking through what would it really take to generate this many dollars?
And what would it take is like the POs in the inventory. And that's where the math starts to often break is like, do you actually have enough cash to buy enough stuff to sell to generate that much revenue? And I think like depending on where you're at, a lot of brand founders when they're just starting out, they may even supplement like profit from the business with cash they have or liquidity they have to help kind of prop up the PO size because they're seeing the return on invested capital makes sense. But depending on where you're at personally, you might reach a point where you just can't like you can't keep up. Like at a certain point, the business has to be fully self-sustaining. So, and ideally, the business has always been self-sustaining, but that is an option you would have. So, at a certain point, it's less so about the percentage year-over-year growth and more about the dollars. But it's not idealistically, it'd be great. But the reality is how do you finance that inventory? And at that point, I guess if you want to maintain that growth rate, unless you're spending off enough cash to be able to afford those POs that are higher, that's when you have to start looking at like, do I grow less or do I supplement with debt or do I supplement with some other sort of capital? And I guess that's where the decision comes. And again, uh, it all comes down to like what you're optimizing for and goals. But normally over time, 100% year over year growth is not going to be sustainable. Like it's just very, very hard, especially at very big numbers. I think that if you are in the camp of like even 50% is really high. If you're
Yeah.
consistently in like the again, so many every business is so different and some businesses can keep on compounding at 100% year over year and that's great. But a lot of brands would be really really happy doing 20 to 30% year over year growth. And
Also, too, like what channel, if you're just D2C, then it starts getting a lot harder, right?
yeah.
Are you, when I see a brand keep going on really, really high growth, once they hit like really healthy eight figures, they start getting meaningful expansion into other channels. And usually at some point, retail, physical retail becomes a big lever, you know? But I actually have a specific question for you because I've run into this several times. Let's say we're just talking about the D2C brand who's ready to go from, they went from 5 to 10 million the year before, and now their goal is to go from 10 to 20. What I have observed, okay, sorry, furthermore, that brand is super seasonal, right? Meaning that like 60 to 70% of their historical revenue is in basically 6 weeks, Black Friday, Cyber Monday. It's like 6 weeks, right? So like I had a brand come to me and say they want to borrow $5 million to go from 10 to 20 million to buy the inventory to do like effectively 70% of their revenue in a 6 week period. They didn't think of it that way. They just said, I want to hit 20 million. I was like, hold on a second. Let's pull the historical data. So we went back and looked at how much ad spend they spent by week, right, in the previous year. And I was like, okay, hold on a second. Do we think we can spend $6 million? This is what I kind of backed into. You think we can spend $6 million in ads in a 6 week period? Because that's actually what we're talking about here. Like, unless we're going to change something from last year. And I'm like, have you talked to your ad agency about this? Because if we go buy this inventory, we're basically saying that's going to happen. Have we sanity checked this with them to make sure that like we're not crazy? Because I'm feeling a little nervous about this. Like, what are your thoughts about that?
I think that's why it's important that like whether it's a marketing agency you're working with or an internal team or whatever, the people driving the ad spend decisions have to come to the table with a forecast of what they expect, or at the very least have to be a part of, hey, I want to go and do X revenue. What do you think it will take to spend to get there, and how do you propose we distribute it throughout the year? I mean, it almost it's not like it almost certainly shouldn't be your only forecast. Normally, over time, as you get bigger, there's going to be multiple parties building forecasts. But I think that that's a really crucial part because if a brand owner who wants to go and spend $6 million says, "Hey, that's the target that I have, or 7 million, or 5 million, or whatever it is," and they think they're going to get X revenue, and then your agency or your internal team member goes, "Okay, I'm going to have Y revenue." In that situation, what's the difference? And if it's pretty similar, you know what? Fair enough. Maybe it is a viable target. But if there's a large difference, that starts a conversation of, okay, so why do you think it's this? I think it's this because of this. And then let's try to get to a place where we can agree that like one is going to be more likely than the other, or maybe there's like something I didn't take into account that you took into account, and we're going to reach like a combined new forecast. And then most importantly, if you're going to make a bet that big, you're probably then going to have your base case and then have scenarios on the upside and downside based off of a couple of variables to make sure if you're going to go and borrow your 5 million bucks or whatever it is, that in that worst case scenario, you're not in a business. So that's usually the workflow when there's multiple parties, and why it's important to have an agency or a team who actually also contribute on the forecasting side.
Yeah, I was just thinking about too, like actually we've done a lot of talking so far about like how to think through how to use marketing metrics to figure out if you should even take on like pre the debt decision, right? But I actually think it's really important, and equally, maybe even more important, to talk about how to use marketing metrics post the debt decision, right? Because even in the scenario that like, let's take the scenario of like we missed the Q4 sales goal by a mile. The marketing metrics didn't play out. Well, we can then look to the next, what do the next 6 months typically look like historically, right? Is there another seasonal spike, a promotional event, this promotional moment that we can take advantage of? Because as long as the debt's not due immediately, right? Or like, and a good CFO, again, going back to the maturity matching, a good CFO, like we do at Free to Grow, will help you make sure that your debt payback has a long enough runway that you can miss your goal and still live to fight another day. Because again, we want to remove layers of risk wherever we can. And one of those is how soon is this debt due? And so, you can also come out of totally missing a sales goal after investing in inventory with debt, and sit down with your marketing team and go like, all right, guys, what's the plan going forward? Let's use the last couple years of marketing metrics for the 6 months after the holidays, right? And let's map out how we can get things right sized, And I mean, we talked a lot about that, about some of those tactics in episode 4, merchandising your ad account, and like how to think through like getting through overstocked inventory. So definitely check out that one if you haven't. There's one other thing I just want to mention that I think is interesting that a lot of brands don't think through, which is splitting the difference. I call it splitting the risk difference on purchasing big lots of inventory. So it's like, take out some debt, purchase a big shipment, right? That's usually cheaper because you've purchased more, so you got better pricing. Maybe you put it on the water on a container instead of ocean freighting it. But don't buy enough for your entire big sales goal. Buy it for some amount that your CFO helps you figure out is a good risk-adjusted bet. But then have your supplier ready to ship smaller shipments, which will cost you more, right? Maybe you need to air freight them, but you find that you're ahead as long as you're generating more contribution margin dollars, even if your gross margin ratio is down because you're air freighting smaller shipments. As long as it's contribution margin, like it still is accretive to the bottom line without stocking out, right? So it's still better than stocking out. And so I call this splitting the difference, right? Like, so we're not going to go all out, but we're also going to have a contingency plan to be less profitable, but still profitable on smaller air freight shipments or like whatever expedited shipments if we end up ahead of our expectations.
That's such a good point, and I've seen a lot of operators tactically use that strategy before, and I think it's a great way to, because a lot of the times founders have a strong like a goal and they want to reach it and they want to do whatever it takes to reach it, and this is a good way to kind of put in those safety nets where you have the ability to, you're sacrificing a little bit of margin to do it, but if the sales velocity come time is not there, you just don't. Because if you do it and you have all that inventory, there's like a real risk to the business. And I think like risk adjusted returns is like it's like an interesting statement because like it's really hard to define risk in something like this, and you never know exactly what the real ROI potential is until you're actually in the moment. But like at the end of the day, it is like the number of times we at Aplo have seen people get into like just crazy overstocked inventory positions is not good. Like it is probably the most common mistake we see in trying to scale a D2C brand is either ordering way too much of the wrong thing or ordering like way too much of a seasonal product. It's pretty uncommon in like non-seasonal businesses where there's not a lot of SKUs and it's like a relatively easy thing to demand plan for. But if you have a lot of SKUs in your business and some of them are seasonal, like the general advice I would give is like, yes, you want to plan for growth, assuming that the metrics are supporting that, but you're probably better off selling out than you are over purchasing, unless you can really afford to wait until the next year to sell them again in some scenario, depending on how you're financing that or what your balance sheet looks like. But like, it is okay to sell out of things. That is like the general thing I try to tell people. A lot of brand owners, the second they sell out of a key SKU, it's like, oh my gosh, like this is not good. Like customers are going to be mad. And it's like maybe if you're on like you want to make sure you don't sell it as something that's on subscribe and save. But like at the end of the day, if it's just a product that new customers are generally buying and you temporarily have to place it out of stock, it's
Totally.
probably a better scenario than if you are dramatically overstocked. And that's not to say you should optimize for that. Like you should try to never be out of stock of your key movers. But I'd much rather be in that seat than the seat of, hey, I have 18 months inventory on hand. What am I going to do about it? It's not.
I totally agree. We reached that point too many times at Guardian Bikes, and I've seen too many brands run into that same situation. And so I advise brands you have to choose one or the other. Like it's okay to stock out. We're gonna live to fight another day. Like living to fight another day is what it's all about. Risk adjusted returns are what it's all about. It's not about like gross returns not adjusted for risk because there are potential returns that could be 25% in an investment, but you could lose it all. And then there's the potential to maybe make 7 on real estate, but your real estate, if it's insured, is never going to go to zero. It may be less liquid, but it will never go to zero. You cannot compare those two IRRs to each other.
It's also not always linear. Like you could be looking at like, hey,
Totally.
I did 5 million last year and I want to do 10 this year. And you're halfway through the year and you're looking at the board and it's like, yeah, I could like safely do 8.5. But just by adding that extra 1.5 million of like the inventory you need to buy to do it, that can take it from like a really great risk adjusted to return where like, hey, I might go out of business if it doesn't go well if I really like order up and lever up to place this PO. And it's like you gotta ask yourself, like, do I want to finish the year at 8.5? Still pretty healthy growth from 5 or whatever arbitrary number you want to pick. Or do I want to risk my entire business and go to 10? And it's like, well, I think I can get 10. And it's like, but is it really worth it? Like, and it's a really delicate line to thread because again, it's all very much scenario based and you never truly know. But
Yeah.
it's again just such a common mistake we see. So it's important to make sure that you have either the time and the people around you to help make an informed decision.
What you just said illustrates why marginality matters. Marginality meaning like what is the next dollar, or like you're saying, what's the next 1.5 million of revenue? What does that look like as a segment,
Yeah.
profitability and cash flow wise? So look, to land the plane here, a few things to take away. One, think about marginality related to debt, right? Like how risky are the next dollars that you're going to spend in growth that you're going to use this debt for. The next takeaway is the riskier that the bigger the bet, the more apprehensive you should be about how much debt you use. You should use less debt as a percentage of the total capital as the bet gets bigger and riskier. And the third thing is like marketing, marketing metrics. The team that's driving sales, like they have got to be involved in these decisions because like actually at the end of the day, because most D2C brands are using debt for inventory, the marketing team has most control over how that stuff is going to move. And so like the cross-functional communication and analysis is key. The best brands do it. The brands that get in trouble oftentimes don't. And even if you get yourself into trouble, but you got your marketing team at the table, you've got more brains to help you get out of that trouble, right? So super important. Start thinking about marketing and debt together because if you run a D2C brand, they are connected. I think that's it for episode 6, man. That was a good one.
I agree. Couldn't have said it better myself. Thanks, John.
Awesome. Later, man.